Hello everyone. Today's market looks positive at first glance, but when we look beneath the surface, the picture is much more fragile. Wall Street pulled back from the edge of new record highs. Optimism around peace talks between the United States and Iran increased. Oil prices moved lower. European equities closed higher. But despite all of that, technology stocks came under pressure in the United States. More importantly, selling in only a few major technology names was enough to weaken the entire market mood. That tells us something important. This rally may still be strong, but it may also be narrow. If the market is being carried by only a small number of large stocks, then even a small stumble in those names can change the whole picture. So today, we need to look at the divergence. Why did the Dow Jones hold up? Why did the Nasdaq come under pressure? What do the moves in Alphabet and SpaceX tell us? Are large artificial intelligence investments and rising debt becoming a new market risk? And what do the technical charts say for the S&P 500 DAX gold, oil, and euro dollar? The United States market showed a clear divergence. The S&P 500 fell 0.4%. The Nasdaq Composite lost 1.3%, but the Dow Jones Industrial Average moved against the trend and closed 0.3% higher. So this was not a broad market sell-off, but pressure on technology was clear. The Dow was supported by gains in Caterpillar, JP Morgan, and Amgen. On the other side, losses in mega-cap technology stocks were enough to pull the broader market away from record territory. The main message is this: we can no longer read this market only by looking at the index level. There is a serious quality difference inside the index. Some sectors and some stocks are still holding up. But the technology segment, which has been one of the main drivers of the rally, is showing more vulnerability. One of the most important sources of selling pressure was Alphabet. Alphabet shares fell 5.1%. The reason was the confirmation that John Jumper, vice president at Google DeepMind, will leave the company to join Anthropic. John Jumper shared the 2024 Nobel Prize in Chemistry for his work related to artificial intelligence. So the market did not treat this as a routine management change. According to the source, this was recorded as the second major leader that Alphabet has lost to a competitor. But the bigger shock came from SpaceX. SpaceX shares fell 16.3%. The stock dropped to $154.60, its lowest level since it started trading. The selling followed a Bloomberg report that Elon Musk's rocket company had issued investment-grade bonds for the first time as part of a planned debt financing process linked to its artificial intelligence ambitions. The company is reportedly aiming to raise at least $20 billion. The critical issue here is not just one company issuing debt. The critical issue is this: artificial intelligence investment is no longer only a growth story, it is also becoming a financing story. And the market is starting to ask a more difficult question: will all this artificial intelligence spending generate enough return? One of today's most important themes is debt linked to artificial intelligence investment. Alphabet, Amazon, and other companies have raised more than $300 billion of debt since November in connection with artificial intelligence spending. That is a very large number. And it shows that the market has entered a new phase in the artificial intelligence story. At the beginning, the narrative was simpler. Artificial intelligence would create productivity, companies would grow, chip demand would rise, data centers would expand. But now the second question is becoming more important: how strong will the return on these investments actually be? UBS Chief Investment Office said that geopolitical developments will continue to create short-term volatility, but it also warned that changes in investor confidence around the sustainability of the artificial intelligence rally could create turbulence of its own. Miller Tabak pointed to an even more specific risk: the risk that hyperscale companies may generate low returns from massive capital spending, while at the same time entering a circular investment pattern in which companies finance each other and commit to buying each other's products. So the issue is this: if artificial intelligence investment produces real cash flow and real productivity, the story remains powerful. But if it turns into a circular spending loop between companies, then the valuation premium attached to this theme will start to face more scrutiny. That is why today's selling matters. This is not just a routine technology correction, it may be one of the first stronger questions about the financial quality of the artificial intelligence rally. Under normal circumstances, positive news flow between the United States and Iran could have supported risk appetite more strongly. Washington issued a 60-day license allowing Iran to sell oil in international markets. That gives Tehran an economic lifeline while talks continue. Vice President J.D. Vance said the first round of negotiations went very well and that Iran had agreed to readmit nuclear inspectors. But Iranian officials described that statement as inaccurate, so there is optimism on the geopolitical front, but there is no full clarity. The market may be pricing a lower geopolitical risk premium, but it is still struggling to turn that into a broad risk on move. Because at the same time, another question is getting bigger. Is the artificial intelligence rally truly sustainable? Europe had a more positive session. The Stoxx Europe 600 closed 0.7% higher. Banks led the gains. Media and consumer stocks lagged behind. Risk appetite improved after European Central Bank President Christine Lagarde said the institution did not need to respond more forcefully to the impact of the Middle East conflict. But there was still divergence within Europe. Hermes fell 5.4%. The pressure came after analyst expectations that profitability could be hurt in the upcoming first half results. That weighed on the luxury sector. Umicore fell 3.5%. The move followed a downgrade by Berenberg, which argued that cobalt prices had probably reached their peak. EasyJet rose 2.5%. That gain came after the board rejected Castle Lake's offer. In the United Kingdom, the FTSE 250 index recovered earlier losses and closed flat after Prime Minister Keir Starmer confirmed that he would step down and open the way for Andy Burnham. European equities are up 8.1% so far this year, but they are still behind the S&P 500, which is up 9.2%. On the commodity side, the most important move came in oil. Oil prices fell after the first round of talks between the United States and Iran was completed in Switzerland, and both sides agreed to continue negotiations this week. The two sides also agreed to establish a deconfliction coordination unit to address conflicts in Lebanon. Brent crude fell 3.3% to $77.95 per barrel. BNY said that most of the positive news around the conflict may now be priced in, and that oil has become secondary to broader financial conditions. Gold moved in the opposite direction. Gold rose 0.9% to $4,191.82 per ounce. Iron ore fell 0.3% to $98.30 per ton. In currencies, the United States dollar was broadly stronger. The euro fell 0.4% to $1.1426. Sterling rose 0.1% to $1.3249. Bitcoin gained 0.8% to $64,207. In bond markets, the United States 10-year Treasury yield rose 5 basis points to 4.51%. The Australian 10-year yield stood at 4.81%. On today's economic calendar, the European Union has PMI data at 6 p.m. In the United States, PMI data will be released at 11:45 p.m. The Richmond Fed Business Conditions Index will be released at midnight. These data points will be watched for signals on growth and risk appetite. But today's main focus is not only the macro calendar, there are three bigger questions. First, will the selling in technology stocks deepen? Second, will artificial intelligence debt become a bigger concern for investors? Third, will the United States and Iran talks continue to push oil prices lower? Now let's move to the technical picture. For the S&P 500, the daily chart still points to an upward trend. The index is at 7,467.13. The price is trading above all three key moving averages. That confirms a classic bullish alignment. The 14-period TMA stands at 7,444.85 and acts as the nearest dynamic support. This area is important for the short-term bullish structure. Daily closes above this level would show that buyers are defending the first support zone. On the upside, the key resistance area is between 7,600 and 7,750. That zone represents the next major resistance area near the all-time highs. The daily SMI indicator is at 27.52 and 26.92 in positive territory. That means upside momentum is still present, but the index is not yet in an overbought zone. So the daily picture remains positive, but the 4-hour chart is more neutral. On this time frame, all three TMA lines are almost fully converged. There is a dense moving average cluster between 7,463 and 7,485. This compression matters. The next breakout from this zone could provide an important signal about the next major move. In the short term, the SMI has produced a bearish crossover. That suggests consolidation or a limited pullback may be more likely than an immediate continuation higher. In summary, the main trend in the S&P 500 is still upward. But in the short term, the market is sitting in a decision zone just below the highs. The technical picture for DAX looks more constructive. The daily chart supports an upward trend. The index is at 25,059.68. After the sharp decline toward roughly 22,000 in April 2026, DAX has made a strong recovery. The price is trading above all three key moving averages. The 14-period TMA stands at 24,756.96 and acts as the nearest support. On the upside, the first target is 25,500. If that level breaks strongly, the second target is 26,000. The daily SMI indicator is at 53.97 and 43.33 in positive territory. The main line is above the signal line, which confirms that momentum remains constructive. The 4-hour chart also supports the bullish view. The price is above all three TMA lines. The 14-period TMA is at 25,029.57. The 50-period TMA is at 24,820.54. The 200-period TMA is at 24,717.02. Together, these averages now form an important support zone. For DAX, the first short-term resistance is 25,300. Above that, 25,500 becomes the next key level. In summary, despite short-term technology pressure in the United States, DAX remains technically balanced and constructive. Gold tells a different story. The daily chart is bearish. The price is at 4,184.57 and is trading below all three key moving averages. The 14-period TMA is at 4,252.42. The 50-period TMA is at 4,516.47. The 200-period TMA is at 4,468.94. All of these averages are above the current price. That means they are acting as resistance during any recovery attempts. Since March 2026, gold has been forming a clear downtrend with lower highs and lower lows. The daily SMI indicator is at negative 33.46 and negative 31.10. That is close to oversold territory. But according to the technical source, there is no confirmed bullish divergence between price and the SMI at this stage. So any rebound should be treated as a technical relief rally, not as a confirmed trend reversal. The first downside target for gold is 4,100. If that level breaks, 3,950 becomes the next area to watch. On the upside, 4,252 is the key resistance. The technical outlook for WTI crude oil is also bearish. The price is at 75.570. It has fallen sharply from the April 2026 high near $120. On the daily chart, the 200-period TMA is at 74.594. This is a critical support area. It combines moving average support with an important horizontal support zone. The 14-period TMA is at 84.199. The 50-period TMA is at 94.684. The 14-period average has moved below the 50-period average, forming a classic death cross structure. That suggests that rebounds in oil may continue to face selling pressure. The daily SMI indicator is at negative 85 and negative 83.228. That is extremely negative momentum. Levels like this can produce technical rebounds. But the key point is that price is making new lows while momentum is also weakening, so there is no clear bullish divergence. The main support is 74.60. If that level breaks, $65 may become the next downside target. Eurodollar also has a bearish daily chart. The price is at 1.14255. After failing to hold above the 1.18 to 1.20 area from the February 2026 cycle highs, the pair broke below all three key moving averages. The 14-period TMA is at 1.15265. The 50-period TMA is at 1.16454. The 200-period TMA is at 1.16688. These averages now form a strong resistance ceiling above the price. 1.15265 is the first critical resistance. On the downside, 1.14 and 1.13 are the support levels to watch. The 4-hour chart also supports the bearish view. The price is below all three TMA lines. The 14-period TMA is at 1.14493. The 50-period TMA is at 1.15331. The 200-period TMA is at 1.16118, so short-term resistance is layered above the current price. In summary, the main trend in euro-dollar is lower. Rebound attempts are possible, but unless the pair regains the 1.15265 to 1.15331 area, any bounce should be seen as a correction rather than a trend reversal. The big picture today is this. The market is not in full risk-off mode. The Dow Jones rose. European equities closed higher, oil prices fell. The United States and Iran talks are reducing the geopolitical risk premium. But the market is not fully comfortable either. Technology stocks sold off. The Nasdaq came under pressure. Large names such as Alphabet and SpaceX saw sharp moves. And artificial intelligence investment is now being questioned not only as a growth story, but also as a debt and return quality story. So the message from today's market is clear. The rally can continue. But investors now need to look beyond the direction of the index. They need to ask what is actually carrying the rally. If the market is being driven by only a few large stocks, a few themes, and investments financed by large amounts of debt, then the rally may look strong technically while remaining structurally fragile. Today's market told us something important. Lower geopolitical risk does not automatically make everything comfortable. Oil can fall, Europe can rise, the Dow Jones can hold up. But if confidence in the technology segment weakens, being close to record highs may not be enough. The S&P 500 is still technically in an uptrend. DAX remains constructive, but gold, oil, and euro-dollar are showing more clearly bearish structures. This is not a one-direction market, it is a divergent market. And in a divergent market, the most important question is not simply, is the index going up? The better question is, who is carrying the rally, how strong are those leaders, and how sustainable is the story behind them? That is where the real answer lies. In this video, we did not only look at the daily market move, we looked at the fragility behind the move. Do you think today's selling is just a short-term technology correction? Or is the market starting to question the sustainability of the artificial intelligence rally more seriously? Share your view in the comments. This content is not investment advice. The goal is to read market data and technical levels together in order to build a clearer framework.